So our focus should be on, as an investor, to look forward to investment ideas, whether the GDP growth impact is there and how much. Various experts have predicted right from 0.2% to 0.5%, which is not much of an impact as of now.
What do you think are the key triggers ahead for the market to move forward?
Definitely, what is the net outcome on the tariff front? That is, market is going to watch out on that, and whatever is that outcome, its overall impact on the macroeconomic parameters.
Hi, welcome to Moneynomics by Axis Mutual Fund. I am Shalini Gautam, and I have with me Shreyash Devalkar, Head Equity. Today, we are going to talk about the developments in equity markets, the tariff scenario, the earnings season, how it has played out so far, and what should investors do. So Shreyash, let's begin. Again, 25% and a 25% tariff. So what do you think? Will these tariffs come down? Will India be able to negotiate these tariffs? What does the impact look like?
So whether this will come down and the negotiations will be always on. So I don't think that this is full and final. Indian government is obviously in talks with them. There are already in media, it's published that there are multiple meetings are going to be held in this month itself. In my opinion, definitely this tariff should come down. If you look at the impact wise, then as an investor, we should look at what is given in as of now and then its impact. If you look at from that point of view, then definitely there are certain categories like textile, chemical, where there is a straightforward impact. There are certain categories where there are exemptions, or there has been exemption.
Okay.
We need to see whether it will continue or not. But again, because of that, the certain categories where there has been exemptions, there can be some relief on that front, which one may assume here. Overall, yes, the tariff is high, and that's where even if some sectors gets affected, that has an impact on overall growth. But our focus should be on, as an investor, to look forward to investment ideas which are relatively less affected by this, and also there are going to be certain impact on overall economics front. Whether the GDP growth impact is there and how much. Various experts have predicted right from 0.2% to 0.5%, which is not much of an impact as of now. Considering this overall thing, as an investor, we should look forward to the areas where the overall impact is less, and that's how we are also looking at our end.
Okay. Now coming to the earnings season, the first leg is almost done. How do you see the season pan out so far? In your view, what are the sectors that have done reasonably better, and which are the sectors that have taken the hit?
Sectorally, at least last few quarters, what we have been observing is the earning cut, people do it even ahead of the result season. So in that context, there is earning cut, probably at least 40-50% of the companies. However, that earning cut may not be to the very high extent. So it's not like 10% plus and all. It's marginal 2, 3, 4%, because already the expectations are toned down. And if you notice that for FY26, the earning growth expectation is in high single digit. So that expectation having come down already, there is a cut, but that cut is not to the extent which is alarming as such. Sectorally, if you see, IT as a sector has shown poor result, and that trend continues. So there is no change in trend for that. In financial services, actually, the NIM, or the cost of fund and its impact on the NIM, that impact has been in certain cases higher, in certain cases lower. But more important was on the credit cost front. Unlike earlier quarter, the change in trend was that multiple companies, multiple banks and NBFCs highlighted segments where there is asset quality concern. Again, that highlight was not alarming as such, but earlier there was not many instances. Now, apart from MFI, there is a CV, there is unsecured lending to SME, some other. So there is no uniform commentary on this, but individually some banks and NBFCs are trying to highlight. So this is where another caution, so to say, which has emerged in this result season on the financial services front. Results in actually capital goods has been really good, especially in the capex stories which are around power sector related capex. These results has been good, and that's where you are seeing that impact on the stock performances as well. So mostly electronic manufacturing services, capital goods, the results has been great. I think earlier we would have spoken about multiple themes where the growth is good. In those themes, I don't see any dent so far. So the themes has been on the B2B side, capital goods, power sector oriented, electronic manufacturing services, some of the auto ancillaries. While on the other hand, on the B2C side, it is about airline, transport, tourism, it is about retail industries growth. So on all these front, quick commerce, so on all these front where there has been theme, as of now the result has been in line.
Okay. Now July has been a month of consolidation. We have seen markets fall given the tariff scenario and the earnings season. What do you think are the key triggers ahead for the market to move forward?
Definitely, what is the net outcome on the tariff front? That is, market is going to watch out on that. And whatever is that outcome, its overall impact on the macroeconomic parameters. In my judgment, as of now, it doesn't look like very high, but we don't know how it is going to shape up. So that is one aspect we need to look forward to. Apart from that, as of now, there is probably lack of trigger of in near term, in next 3 to 6 months as of now, what we can look forward. And that's where when such a situation arises, so that same thing happened probably in the second half of last year post election, because then there were not many trigger, and then in such a scenario market tend to fall back to on the basics, which is earnings and consolidation. So in my opinion, that consolidation will continue the way it has happened. Already 1 year of consolidation is behind, with probably mid-single digit kind of returns. Within 5 to 6 months, if we continue in this manner, and once you are in 2026, you will look forward to FY28 earnings. So that will be the time, in my judgment, where one may become more constructive on the market. Having said that, as always, which we highlighted even last time, the segments where growth is less, their valuations are reasonable, if not cheap. While the segments where growth is high and the themes are really good, their valuations are high. The net outcome is less growth is not yielding you returns, while high growth, because of the high valuation, is not yielding you a return. That's where for investors, we should look at any fund, either one should be in balanced advantage kind of fund or in a diversified category. It can be multi-cap, it can be large and mid, it can be flexi or ELSS kind of funds. Broadly, these kind of funds are diversified, wherein there is a mix of reasonably priced low growth stories as well as expensive high growth themes. So that is the right place to be.
Against all of this backdrop, the way the scenario is, how are you positioned in your funds?
So in our funds also we have a mix of this. So it depends on the category. As always, large cap oriented funds are more consumer oriented, while mid and small cap oriented funds are more B2B oriented. That it is more because of the structure of those funds, while the diversified funds, as I said, is a mix of both. The segments which are growing slow, we have reduced exposure, but we continue to have some, especially because valuations are reasonable in those places.
Thank you, Shreyash. That was really insightful, and thank you for taking time out today. Thank you to all our investors for tuning in. Please stay tuned to Moneynomics for more such insights. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.